Hi, my name is Jordan Wilson. Today we're going to look at investor profiles, specifically on the part of the profile that deals with the financial situation. I'm not going to spend a whole lot of time on the financial situation aspect of investor profiles. We could have a long accounting conversation, but that would please neither of us, I think. If you want to build your target asset allocation and a successful investing base, the first thing you probably need to do is understand where you are from a financial perspective. There's kind of an old joke, I think, that goes around that says if you want to amass $2 million in 10 years' time, you're better off starting out on day one with $1 million than with nothing. And you're even better if you start the journey with 3 million than 1. So where you start the process will sort of dictate how much risk I need to assume in my portfolio, because there's a correlation between risk of an asset and its expected return. The greater the risk, the greater the expected return. So if I want to go from 1 million to 2 million in 10 years, that's approximately a 7% per annum return. Can I get that today investing in term deposits? No. You have to take on risky assets. If I start out at zero and want to go to 2 million in 10 years, then I have to take on even more risk. Or conversely, for both those scenarios, I have to make greater periodic contributions to my investment portfolio. So that is kind of where we are. We need to know the current financial situation to make realistic plans to invest for our goals. So the balance sheet, you want to invest, or you want to list your assets, your liabilities. You probably don't want to do it at cost. So if you bought a vehicle 5 years ago for $50,000, is it worth $50,000 today? Likely not. So if you had to sell that, you want to know what your market or your net realizable value is when you create this personal balance sheet. The second aspect would be a cash flow statement. And that's just the actual cash coming in and out your door, probably on a monthly basis. You could do an income statement, but there's so many non-cash components to an income statement that cash flow is probably more important. I think this is an area, the cash flow statements, where individuals tend to have the biggest problems in starting out or seriously beginning their investing patterns. I think most younger families that I encounter tend to be quite tight or even run shortfalls on their cash flow. So how do they come up with $300 a month to invest? And again, that's the investing program, is you either take on higher risk investments to earn higher returns, or you contribute more on a periodic basis. So if I need $2 million in 10 years, maybe that works out to $300 a month. But if I need that 2 million in 5 years, maybe now I need to invest $750 or $1,000 a month. So there's that connection between free cash flow and your ability to invest. And this is kind of why the younger you can start investing, you develop good habits. It's almost like a phone bill monthly after a while where you forget that $300 or whatever it is just automatically being deducted from your salary and going into a tax deferred investment account. Whereas suddenly if you've got to find $300 on a monthly basis, that can be tough. And this is actually an area I think where a competent financial planner can add value, is in budgeting, in looking for ways to generate more free cash flow so that you can invest. I think the key issues here, at least to me, I mean, there's many issues, but the three keys I'd like to mention are liquidity being the first. And again, that kind of goes to the $50,000 car. What is it worth today? And what would your house be worth if you had to sell it quickly? You know, again, you don't want to just, oh, it was appraised at $500,000. That's what we'll list it at. Try to be a little bit more realistic or even conservative in your estimates. Because if there is a fire sale requirement or some sort of thing where you need your assets quickly, it's nice to know what the real value is, not just, oh, you know, I bought this car at 50,000, we'll just list it at 50. A holistic approach is also important and something that's missed by a lot of people. By holistic, what I kind of mean there is look at all your assets. And a lot of people just, when they consider their investing their policy statements or their investor profile, they just think bankable assets. What's my RRSP? What's my TFSA balance? These sort of things. But you have other assets. You have your house, maybe a lake cottage. So again, take a holistic. And the other one people tend to ignore when they do their target asset allocations is, do I have a company pension plan? Especially if it's defined contribution, because then that's being allocated to certain investment funds, maybe a balanced fund, maybe an equity fund, maybe fixed income. So when you look at your target asset allocation, you need to factor in investments from different sources so that you don't overstep in certain areas. For example, if you're defined contribution, you put all your money into a fixed income fund, then that goes into your entire fixed income asset allocation. If you just say, I want a 60-40 split in my RRSP between equities and bonds, you might end up with 55 or 60% in bonds because you didn't factor in your pension fund. Same holds true with employee stock purchase plans or employee savings accounts. Make sure that all your potential investments and all your assets are covered. Geographic or employment overemphasis. So to me, geographic is an issue, excuse me, in Western Canada, especially Saskatchewan, where I live. So a lot of people, they have a house, maybe in Saskatoon, where I'm based now, a lake property, probably within an hour or two of the city. So that's a lot of real estate as an asset. And you want to include that in your balance sheet, obviously. But if there is an economic downturn in Saskatchewan, then there's a good chance that your residential property is going to take a hit. And even more so, probably your lake property, because I think there's probably more volatility on secondary properties during bad times. So I can afford to sell my lake property if financial conditions are poor, but I still need a house in the city to live. So there's a little bit more volatility or price swings, I think, in secondary properties. You also saw over the last decade a lot of people, when housing prices were going up, were buying condos or second houses in the city to rent out. And the idea was we'll rent them for a period of time. There'll be continued capital appreciation and the rent will pay the mortgages, and then we'll flip the house. We went through a housing issue in Saskatchewan, and a lot of people were left in tough circumstances because suddenly they had this house that they expected to flip in 5 years and make 50 or 80% on, and it's below the price they paid. So again, geographic is that sort of a systematic risk that we talked about, where if the economy goes poor in a specific area, then everything might suffer. And if you own 2 or 3 properties in this province, then in the good times they'll all rise, the bad times they all might suffer. So there's that lack of diversification. On the employment side, very, very similar issue. A big employer in Saskatoon would be, say, Nutrien or Cameco. When potash prices are strong, there's bonuses, there's promotions, it's good times. But if the share price is down and the economy's down, then there's much less of that. And you also run the risk maybe of getting laid off, which is especially true if you work in one of the mines. But what you see is people have employee stock purchase plans, or they buy shares in their own company. So you can have sort of an over investment in your own company, and you run the risk of, okay, I have shares of the company, I'm employed by the company, that's my income. But if bad economic times arrives, the share price stumbles, you don't get your bonuses, maybe you get laid off. So you can again be hit by many different aspects just because you're over invested or over relied on your employer. So that's something to consider. And for a while, still, Nutrien, as the example we used, is very prominent in Canadian equities. So even if you own a general Canadian balanced equity fund, you're going to have exposure in that fund to Nutrien. So again, you just have to be careful of your diversification in your portfolio and where things can impact you if bad times come to Nutrien or Cameco or any other company that you're employed by. Once you've done your current situation, you probably also want to look at your forecast, your prospects, what the future looks like. But you want to be realistic, and I would even say cautious in how you view things. If your cash flow today is based on a $50,000 a year salary, is your salary going to be $50,000 in 3 to 5 years? Probably not. It'll probably go up. But will it go up to 100,000? That's sort of be realistic, be cautious. What's the inflation rate? So if I'm renting a condo, is my cost of living going to accelerate? So my salary might go up, but you can't just say, oh, I'm paying $1,000 for rent and I'll continue paying $1,000 for rent for the next 10 years. Probably not realistic. What kind of growth areas do you have? So what areas in your cash flow do you think you can expand on? Maybe it's adding new skill sets that will give you that nice bump in salary. Maybe it's buying a small house and incurring a mortgage payment that's less than the rent. So what areas can you exploit going forward and factor into a forecast financial situation? Same with savings. The big one over the last few years has been people cutting the cord. So they get rid of their cable TV in large part, and that saves them maybe a couple of $100s a month. So that's an area, if you look at your current cash flow, where can I save? And this is an area I think again where a competent financial planner can add value to individuals and families to help them because they've seen it all. So they'll come in the door and their experience just doing 50 previous clients readily translates into looking at your data and saying, oh, do you need HBO? No, here's the saving. So that can help you out as well. On the investment portfolio side, again, you want to look sort of, what's my portfolio done? Where am I? Am I averaging like 3% per annum when, a balanced portfolio or a balanced benchmark is averaging 8%? So are there opportunities there for my investments? And again, this is an area where you definitely want to be cautious because if I'm assuming a 10% return on an investment or my portfolio, and I only get 7%, 10 years out, you can't go back in time and rejig your portfolio. And if you relied on 10% for your retirement and you only get 7, you have a significant shortfall. And usually that can't be compensated for because the time has passed. Whereas if I sit there and I'm hoping for an 8% return, but I plan for a 6% return as far as my contribution flows go, I'd much rather wake up in 15 years and go, oh, I made a huge error. I wanted $2 million and I've got $2.5 million. That's a lot better problem to have than, oh, I ended up with 1.5 and I need 2. You'd rather be cautious in your forecasts and end up with more. At least that's kind of the way I think. And then again, where do we have opportunities to save? An example in Canada would be most people have contribution room in their registered retirement savings plans or their TSFAs. So if you have space in a tax deferred account, that's an opportunity. The more you can put in there, the more your money can grow and compound on a tax deferred or tax free basis. So what sort of opportunities do I see for my current financial situation that I can exploit going forward? I think that covered everything nicely, at least on the financial situation. And again, the key is you need to know where you are today to get where you're going tomorrow. And if you start with 0, that implies a certain contribution stream, a certain risk tolerance, because you're chasing certain expected returns that are going to be different than if you're starting today at 1 million or 2 million or 3 million. So again, that's the first phase of your investor profiles. Figure out where you are today, and that will help lay the groundwork for how you get to tomorrow. That's all we have time for today. Thank you very much for listening. And I think we'll move into investor objectives and constraints next session.